In this session, we are going to calculate holding period return. If we are holding bonds, stocks, and different investments for 2 months, 6 months, or for 1 year, when we are holding any asset or any investment, we have to calculate the holding period return. Now, in this question, you will find two bonds, up funds and MP funds. This is a mutual fund, and NAV as on 31st of March 2009 is 80, and NAV of MP funds is 65. NAV as on 31st March 2011 is 95 and 80. This is the closing NAV, and this is beginning NAV, and this is ending NAV. Beginning NAV is buying NAV, the price at which we have bought 80, and we have sold at 95. During the period which we were when we were holding the particular mutual fund, in that period we received a dividend 15 rupees in both the funds. So this is the income during the period. Formula of holding period return is P1, price at the end minus price at the beginning, P0, price at the beginning plus income during the period, dividend plus, divided by price at the beginning. HPR is equals to 95 minus 80 plus 15 income divided by price at the beginning. This is the investment amount, so divide with the investment amount, price at the beginning. Into 100, you will get 37.5. And if you calculate the period of holding this particular mutual fund is 2 years, from 2009, 31st March 2009. This is the purchase date, and selling date is 31st March 2011. So you are holding the mutual fund for 2 years. You will divide with 2, you will get 18.75%. For the second mutual fund, the MP funds, same formula, holding period return, price at the end minus price at the beginning plus dividend divided by investment price at the beginning, purchase price into 100. HBR is equals to 80 minus 65 plus 15 divided by 60 into 100. Holding period return is 50% divided by 2, that is 25%. Second question, from the following information, calculate the holding period return and annualized return of two bonds. Now the prices are different. NAV is on 31st March 2010, 70, and MP funds NAV is 100. NAV is on 31st March 2012, 100 and 110. Dividend for the period is 15 and 15. Solution, holding period return, price at the end minus price at the beginning plus income during the year divided by investment, P0, price at beginning, into 100. 100 minus 70 plus 15 divided by 70 into 100. Annualized holding period return is 64.29 divided by 2, because you're holding from 2010, 31st March 2010 till 31st March 2012. You're holding it for 2 years, so calculate the annualized holding period return, 32.15. For you MP funds, P1 minus P0 plus dividend upon P0 into 100. 110 minus 100 plus 15 divided by 100 into 100. Annualized holding period return 25% divided by 2, 12.5%. Question number 3 is similar question. HPR calculation and annualized return of two bonds. You can find the data. Again, you have 2 years holding period. The price at beginning is 250. Price at the end is 200. So here you are going to get a loss of 6%, annualized HPR minus 6%, minus 12% for 2 years and minus 6% for 1 year. Because price at the end is lower than the price at beginning. In case of MP funds, you have benefit of 100. Price at beginning is 200 and price at the end is 300. And during the period, holding period, you receive dividend of 20. So you get 60% return in 2 years. In 1 year, you have 30% returns. This is a question on fair value calculation of a bond. You know the price is currently trading at 800. This bond is having a current price in market 800. First, we will read this question. Mr. Akshay Patra considers rupees 1000 par value bond bearing coupon rate of 11%. Coupon means interest on the bond. And interest is always calculated on face value, that is 1000. It is having maturity after 5 years. So you will get back this investment amount at the end of 5 years. He wants a minimum yield to maturity of 15%. That means interest rate going on in the market is 15% and he desires to get 15% return from the bond. This is used for discounting the bond. This is R, YTM, 1 plus R, 1 upon 1 plus R raised to N. The bond is currently trading at 800. Should he buy the bond? First, calculate the coupon amount. Face value is 1000 and coupon rate is 11%. Amount of interest is 110. Now YTM is given in the question, yield to maturity. This is nothing but investor desires to get this much return from the bond. Now you may be thinking that bond is giving 11% coupon. How an investor can earn 15% from the 11% bond? Coupon is 11%. He can earn 15% by buying this bond at a deeper discount. He has to buy bond at a deeper discount to get a return of 15%. Now, what is that exact discount and what price Mr. Akshay Patra should purchase? At what price he should purchase the bond so that he receives 15% return on the bond? We have to calculate this. Present value of bond, coupon amount is numerator and denominator is 1 plus R raised to 1. Second year, again you have coupon amount numerator, future value, and divided by the discounting factor 1 plus R, that is YTM square. And you have to do it for third year, fourth year, similar, and plus fifth year, coupon divided by 1 plus R raised to 5. And the redemption amount, that is repayment of principal amount upon 1 plus R raised to 5. You will be getting 1000 at the end of fifth year. You will get the face value, that is par value at redemption. So present value of bond 110 is the future value, which you will do discounting with 1 plus 0.15 raised to 1. 110, 1 plus 0.15 raised to 2, plus third year inflow is 110 divided by 1 plus 0.15 raised to 3 plus fourth year future value is 110 divided by 1 plus 0.15 raised to 4 plus 110 divided by 1 plus 0.15 raised to 5. So this is the last coupon, last interest, and next last principal amount repayment 1000 at par, redemption value 50-year future value 1000 divided by 1 plus 0.15 raised to 5. In a normal calculator, you can use this trick. You can use this trick. 1 divided by 1.15. You can press equal sign. You will get 86.8696. Again, press equal sign. You will get 7.7561. Again, press equal sign. You will get 0.6575. Again, press equal sign 0.5717. Again, press equal sign 0.4972. So redemption value is 1000, which will be received at the end of 5th year, which is a future value which is converted into present value. 1000 into 0.4971, or you can write 0.4972. You will get 497.17. Present value of bond. These are present values. The answer is 865.87. In the question it is given the current price of bond is 800. So you will compare the intrinsic value, fair value with the 800. Intrinsic value is greater than the current market price of bond. In this case, the bond is undervalued. So you're getting the bond of 865 at a cheaper rate of 800. You will buy this bond and you will hold it for few years. Similarly, you can write it in the table and you can do this sum. These are the inflows, and 5th year you will get back the principal amount. So first column is years, second column is the cash inflow. This is a future value, and using the discounting factor YTM of 15% yield to maturity, 1 divided by 1 plus 0.15 raised to 1. This is first year. Raised to 2, second year, raised to 3, third year, raised to 4, fourth year, raised to 5, fifth year. And last column is present value of bond, that is 95.65, 83.17, 72.33, 62.89. How to calculate this? 110 multiplied by 0.8696, you will get 95.65. 110 multiplied by 0.7561, you will get 83.17. So similarly, you will do for all these years, third, fourth, and fifth year. The last step is to aggregate the present value of all years. Total of all the years, 865.93. Since the bond price in the market is rupees 800, market price is undervalued, so we will invest in this bond. This is the decision after calculating the present value and comparing the present value with the current market price. After making a comparison, you have taken a decision of investment. So in investment decision making, present value is useful. It's practically applied by investors, those who desire to get targeted return of 15 to 20%. They apply this formula of present value but the bonds are fixed rate bonds. These bonds are fixed rate bonds. So in this, we can calculate the fair value of the bond easily. Next question is find out the value of bond with 8 years maturity and face value is 1000. Coupon rate is 13% and investor desires to get required rate of return means investor desires to get return of 14% from the bond. Now you may be thinking the bond is giving returns of 13%. How investor will get 14% return from a 13% coupon bond? When he will buy this bond at a discounted value, he will get 14%. He will get 14% targeted return. Coupon is paid annually. First step is to calculate the coupon amount on face value. Face value is 1000 and coupon is 13%. 130 is the amount annual interest which will be received in the 8 years. So first year ending and all the year endings you will get till 8th year 130 rupees annual interest. The discounting rate used will be 14% for discounting the future values of 130 because this is the required return of investor. So 14% means 14 divided by 100, 0.14. We will use the table first year to 8th year. Second column will be the future values, cash inflow. 130 annual interest you will receive in all the years and 1000 you will receive at the end of the 8th year. This you have to remember while solving this practical problem. 1000 you have to add, this is a par value you will get at the end of 8th year. Now these all are future values we have to convert into today's value, that is present value. PV factor, present value factor at the rate 14%. 14% means 14 divided by 100, 0.14. Add 1 to it. 1 divided by 1 plus 0.14. Bracket close, raised to 1. You can solve with a calculator trick. 1 divided by 1.14 equal press करेंगे 0.8772. Again press equal sign. Don't erase the result of this first step. Press equal sign. You will get 0.7695. Calculator will automatically calculate raised to 2. After you get this answer 0.8772, press equal sign. Automatically you will get raised to 2 answer 0.7695. Again press equal sign. You will get 0.6750. Again press equal sign 0.5921. So similarly you can get for all 8 years. So this is a factor for 1 rupee. The factor PV factor for first year is 0.8772. Multiply with 130, 0.8772, you will get 114.036. 130 into 0.7695, 100.035. 130 into 0.6750, you will get 87.75. So for all the 8 years, you will do it in this way. In the last year, you will take 1130. Not only coupon, you have to take principal repayment and you have to multiply with 0.3506. You will get 396.178. So highest figure you will get in the last year because you get the principal repayment in the last year. And the last step is to aggregate the value of present value, make a total of this. $953.657. This is fair value of bond. Conclusion is the bond should be available at 953.657. This is the fair value. In this question, they have not given any current market price of the bond. So it is not since the current market price of the bond is not given, so this bond we cannot compare the fair value with the current price. The bond should be available at 953.657 or lesser than this value.